I'm Tim Quast from Market Structure Edge. Thank you for being here. And this is our very informal weekly live discussion, and we try to help you use the tool, and we learn things from you too. So we look forward to that. Since I did this last time, I will hand the mic and control to market strategist Brian Wilson for the first half, and then I'll bat cleanup. So Brian, over to you.
Yeah, thanks, Tim. I appreciate it. Great to be with everyone today. I think many of you know this, and we do get many emails from you. Feel free to send an email to me or Tim at any point. We love the questions, and especially today, if you have any questions as we're going through, please raise your hand or send us something in the chat line. I've got a few topics here to cover, four or five topics, and then kind of the look ahead. My first topic is going to be a little bit different because I'm going to combine. Tim and I both work for two companies. We work for Edge, and we also work for Modern IR. I'm going to share something that I did the latter part of last week for Modern IR. And I think it'll give a little bit of perspective what can sometimes happen around options expirations. I know we're past expirations right now, but perhaps it'll give you something to keep in mind as we go into the next expiration cycle. So with that being said, share my screen. I don't know where this is at, but this is a tea plantation, isn't it gorgeous? Tim, it's probably something like you would see in Sri Lanka, I think. But anyway, that's neat.
And Indonesia and Malaysia.
Yep.
And I've seen them in all places. Yes.
Yep. What I wanted to share with you is what was happening with Ford last week. I didn't trade Ford, but I'll give you an actual example of what was happening around expirations. I did trade three names around expirations, and I'll explain why I was doing that. So the Wednesday before expirations, Ford suddenly starts shooting higher. I think May 13th was 13% gains, and the next day was either 7 or 8% gains. Now, the first day I worked with Ford from a investor relations perspective. I was talking to their internal team that day because they had shot higher, and everyone was trying to figure out, why are we up so much today? There had been a broker item out, but it was nothing that was new. In fact, the news had already been out already. So why are shares doing that? Well, just as a review, and you can see this calendar at any point, just go under resources, and then you can go to expirations calendar. And what you'll see here is expirations related activity. Now, Ford started to go higher on the 13th. What do we know is coming up on the 14th and 15th? Well, options expirations. It started to just catapult higher right ahead of expirations. And by the way, everything that you need to know in terms of those symbols down here on the bottom. And once again, this is on our resources tab. So let me show you what I sent to them. And, maybe it will just help a little bit thinking through, what's happening around expirations, why you can suddenly see sometimes huge gains like we saw in Ford, and sometimes we also get huge losses. So what we saw with Ford, and this is a slide deck that I delivered to them, is we had a surge in passive investment activity, and we had a surge in derivatives related trading. So think about quant fund and risk management buying, probably some quantitative hedge funds that were in there as well. As the news started to hit, you also started to get trend following quants that followed that trend. And here's a key consideration. It was very, very close to May options expirations. So think about a couple of these points that I delivered to them, especially when you get close to expirations. If you really see shares going higher or lower, just recognize what's happening in the background. So what was happening here was the dealers had to hedge their positions. Whenever you have those options trades, Well, they're bought by someone and they're also sold by someone on the other side. So the dealers have to stay delta neutral. So they hedge by trading the underlying stock. Here's the key. If the price is rising, well, the dealers must buy more stock to stay hedged. And this creates a continual feedback loop as Ford was rising to 1350 and then 14 and it just kept going. And as it kept rising, well, the dealers had to keep buying more shares. Once again, we were very, very close to expirations itself. So proximity to options expirations can intensify this hedging both higher and lower. So I just wanted to share that real world example. And we told them, at the end that, recognize that this recent hedging, it's been mechanical. It's not based on valuation. And after options expire, the hedging will disappear and the support will often vanish because there's no longer any forced buying. The counterparties no longer have to buy like they did previously. So that being said, what happened to price afterwards? It did exactly like we thought it would. It went from 1448 all the way back down to 1303. So a fast trip higher and a fast trip lower. Recognize the context. And that's why we tell you guys about context all the time. It's very, very important. Now, this was Ford going higher. I'm not going to share the ones that I bought. It doesn't matter. But what I saw Friday afternoon, and maybe just watch this the next time we have expirations. I've got a watch list, and it's 40 companies long, something like that. Some of them are the clients on my Modern IR side. Others are just random companies. But what I noticed is that a couple of companies Friday afternoon were really getting weak. Why were they getting weak? Well, just the opposite of the Ford example. It the shares were going the other direction. So what were the counterparties doing on the other side? Instead of buying like they did for Ford, they were then selling shares. So what did that create? Well, all things being equal, it created an opportunity. They were way over the normal intraday volatility. And as you're aware, you can check intraday volatility for any stock that you want to. Let's just take one of our big tech examples. So let's say that Shopify was coming under extreme weakness going into expirations. You can check their normal volatility. Let's say it was down 7% Friday of expirations. Well, there's probably a pretty good buying opportunity there. So just wanted to give you a feel for how you can use not only the edge data, but also use the context of the market to your advantage. Next topic today, and you edge veterans will know that I go here often. So what we're looking at here is, I call it sentiment above 6. And I'll show you what I mean here. Let me back this up. So if we look at the normal rhythm of the markets will periodically go above 6. That's the red line. It'll dip back down. It'll go above 6 again, dip back down. The normal cadence of the market is that this period where it is above the red line, market gains tend to be about 50 to 60 basis points. So the market doesn't collapse, but gains slow down. And I'll back it up just a little bit more so you get a little bit better feel for that. So, here's the market going above 6. You can see how we slow down. We go above 6, the market slows down. We go above 6, the market slows down. Now, notice what happened here. That did not occur. The market kept charging higher. Every once in a while, there are outliers in the data. Doesn't happen very often. I have mapped everything from, let's see, how far back did I go? Went back to the beginning of 2020, all the way through to the present. And, there's that average above the red line, 60 basis points. By the way, 2 weeks afterwards, if we measure it, 60 basis points. It's exactly the same. Everything slows down, but the market doesn't tend to collapse. When there are outliers, we pay attention to it. Here's a list of the outliers. What is there? Maybe 12 or so over the course of that period. There's a few that are lower. There's a few times where there were outliers for how long we stayed above the red line. What I wanted to show you was the last couple of times when we had significant gains. So I'm going to take you back to November 2023, and then we're going to look at last February. And what I'm showing you here, you can see November had some really strong gains. 2 weeks afterwards, it had averaged 4%. Here's last April, huge, 12% gains, averaging 2% afterwards. Here's what we did this round, 5%. 2 weeks afterwards, had about 4% appreciation. But let me take you back to last November, and we'll show you what I'm talking about here. And sorry, this is November 2023. So here's the move above the red line, November 2023. What does the market do? Slows down ever so briefly, charges higher. If we look at last May, here's that extreme move above the red line. We tend to have a period of slowing down and then charging higher. We've done the same thing right now. I'm not surprised at all that the market has slowed down a little bit. The question is, do we once again charge higher? I think we probably do. That's going to be remain to be seen, though. Interesting dynamic. I've only tracked this a couple of times, and I might have missed one or two. It's kind of hard to look at them when you're looking back at the database. Here's what I'm talking about, and let me bring this back so you can see it a little easier. So what I'm looking at here is market sentiment that has bottomed. It starts to move higher, but it really goes nowhere, and it starts collapsing again. So basically, market sentiment that very quickly rolls over. And you would think, wow, that's not good at all. And then that's exactly what I would see when we don't get any, strong demand here. It's actually just the opposite. The market tends to pause for a little while, and then it tends to continue to move higher. It's a very interesting dynamic. Maybe that just speaks to the overall strength of the market. I could only find it occurring 3 previous times in the database. Back here in June, you can see this move higher, it moves lower again. What does the market do? It pauses and moves higher. July 2020, right in here, you can see that little move higher, and then it comes back down. Once again, the market pauses, continues to charge higher. And then March 2023, let me give you a better look at this. Let's see if I can find it. Got to go back a little bit farther. All right, March, here it is right here. So you can see the move higher, comes back down, the market pauses, then it once again moves higher. So even though at first glance, I would think a market rolling over would tend to be bad, well, it has been in the short term, but it's not been stopping the market historically. So just wanted to point out those items to you. And I know I'm going into the weeds a little bit here, but it's just a few things that I've been noticing from a broad market perspective. We had a question earlier about the passive investment fund and then entries and exits. And Tim, I'll stop for just a second in case we've had any questions to address. I've got one more topic before we hit the go ahead or the path ahead.
Any questions, comments, observations? And Richard, that's your question. Happy to address it. That's what you're going to do. Brian, go for it.
Yeah, I was gonna look at
I,
how to trade the passive portfolio, and there's a few different strategies here. Unless you want to take it, Tim, that's fine.
well, what I do, and of course, it's because I don't want to sit around. I mean, we don't want to sit around watching screens. This is,
Mhm.
I mean, the beauty of automating everything to the degree that you can do that. I don't automate it, but I'm not sitting and watching. Generally, uh, Richard, what I do is take the reference price. I use market on close orders to do my portfolio balances with the model portfolio, and it's
Mhm.
because and in the last 10 minutes, I'm going to get the reference price. Sometimes that's worse, sometimes it's better. It doesn't really matter on if in the main, what makes that work is demand supply imbalances. And it doesn't always work, but that's a great way to make sure that your trades are going to get executed. You have to have them ready in prior to the last 10 minutes of the trade of the trading day. But that's what I like to do because I can do that and walk. In fact, you could do that market on close. You don't have to worry about anybody triggering your order. You could set them up whenever you want, and they're going to be executed at that point in time. One of the great banes of our existence as traders is, getting stopped and limited. But we'll come to that later. Brian, you might have another thought. We don't always say the
Yeah,
same
yeah.
thing.
What I do basically the same thing, except sometimes I will trade about half of my position the first 30 minutes of the day, and then I'll save the balance for the latter part. But let me show you the current uh, portfolio and just a couple of things to think about. So here's the current portfolio right now. You can see what it's doing so far during the day itself. And let's just take an example here and remember the context of the market. Think about, what these stocks are. And one exercise that I've started doing is I will just keep track of what they are. So AMD, it's in the semis space. We know that semis have had an incredible run over the course of the last 5 to 6 weeks. I want to tuck that information kind of in the, in the background. Why am I tucking that information away? Let's take a look at AMD. So it's up 56%. So 56% on a 1 month basis. Does that make it a bad buy? No, it doesn't. The portfolio is not looking at, oh, it's too far out in front of its PE ratio. No, it's not looking at any of those things. It's basically just a number on a screen, and it's trading it with that consideration. Uh, be aware of that, but also be aware of context. So what I shared with you earlier, let's say let's say that AMD had charged higher going into expirations last week. Is there a chance it could give some of it back right after expirations? Yeah, sure could. In fact, this was probably expirations right in here. You can see that's exactly what happened. So it doesn't necessarily stop you from purchasing them, but maybe if you're around key events, just be aware of what's been happening leading up to the key event and maybe downsize your, position size, something like that. Or if you, want to be more selective, if it's been charging higher, maybe you wait a couple of days, get past expirations. Wednesday was, when we cleared expirations yesterday, then you're ready to go again. So just a couple thoughts. You can just trade the portfolio itself. And Tim, what are we, 45, 46% up on the year? It's
Yep,
done
45.
fantastic.
It has.
It's not
It's
selective at
volatile,
all.
but yeah,
Yeah,
yeah.
but you can be selective around it and perhaps, help yourself a little bit on the edges.
Yes. And okay, let me, Tim Conklin, let me answer that question. So Tim asks, why not pre-market? Well, you could, but just realize that the probability of getting the best price is worse generally outside market hours because, call it 11 to 12% of volume, 90% of volume is in market hours, even though you can trade, in extended hours. And, by December, the NASDAQ, I don't know who all will follow. They want to be trading 23 hours a day, 5 days a week. We'll see. But still, the concentration of prices, the need for a reference price on the part of index funds and exchange traded funds means that you're in all probability going to get a better midpoint price. Now, sometimes that doesn't work in your favor, but that's my thinking. If I'm not going to put any thought into it, that's what I would do. It might be different with daily trading ideas where I still like to do that, but then I might sell right at the open. That's because so that you're taking your gains, not chances. To me, those are different endeavors. You have one's long term, one's short term. The short term trading, you're after small gains that you can repeat. Brad, you wanted to look at something. Brian, am I interrupting here?
No. I'm done except for the look ahead.
Okay, then you and I can share that. All right, so let's go to that. Brad, we'll have a look at Lumentum, which of course the Nasdaq, dumps CoStar and adds Lumentum to the Triple Q. The Triple Q is Invesco's licensed version, but I get it. I'm amused by those things because you think these are just objective vehicles, and I wrote about they're not. You want the good stuff. Everybody does, right? So the ETF baskets are notorious for that. So looking at Lumentum, and Brad, you noted it took a dip. So I mean, sure, it could do. Statistically, it could, of course. I mean, you never know around when demand, which is currently at 7.2, is still above 5. It's above the axis of 5. Stocks tend, in the main, in fact, it's a great basic principle, own things that are 5 or better as a general rule. If you're running a portfolio, statistically, it blows away not doing that. It's just a very good principle. But I would look at this and say, declining demand, rising supply, those things tend not to produce gains. So I wouldn't. But, it doesn't mean it's always going to work that way. It's just, it becomes a very good objective way so that you don't have to think about what you're going to do. You buy generally diverging demand and supply. And you might say, well, what about the model portfolio? Because it doesn't appear to do that. The model portfolio, the reason why you could look at it and go, well, that thing has falling demand, and in some cases maybe rising supply. Why is it adding that thing? Well, the math in the focused passive portfolio is principally, its first focus is, does passive money own this thing? And is it it'll prioritize by market cap, which is why it returns to the same stuff routinely. It's going to take market cap. And then standard deviation between demand and supply of 3 or better. Well, you can get that even when they're coming together. So it's math. And so visually you'll look at it and go, well, that doesn't make any sense. It's not wrong. It's just doing what it's told to do. And then it will exit on two things. Falling demand, you say, well, it doesn't always. Right. Because passive money and market cap trumps that. If passive money is still the lead behavior, that thing becomes subordinated. And so, again, mathematical models are not perfect, but they're better than everything else. I mean, look at Renaissance Technologies. My market desk note today. I mean, it's just so fascinating how that works. Okay, so I will very quickly, in literally a few moments, cover the things that I wanted to cover. One is about stops and limits. We get questions about this all the time. You've got positions, and you say it's daily trading ideas. Great case in point. So you go to daily trading ideas, and the first item here is 10% volatile. So you happen to enter this stock within the entry range. Call it 87. So you bought it at 87, and then you want to sell it somewhere around, call it 93. Take your 2%. If you do that over and over, you will far outperform everybody else. Rather than chasing gains, just take your 2%. Do the math. It works beautifully. And you don't have to worry about it. You don't have to think, well, what if you set your stop? You go, okay, well, it's 10.6% volatile, and I bought it about 87, and I'm going to set it 7% down. So you have a stop 7% down, and wham, you get stopped out. You lost 7%, and you're like, son of a. And then immediately, what does it do? It goes to 88. Right? So you would have made your 2% had you not been stopped out. What do you do about that? Well, it's why neither Brian nor I are fans of stops. The problem with stops and high frequency traders don't use them. What they're doing is they consume data that tells them where the ranges are and where the gaps are, and then they execute marketable trades. Of course, they've got extremely high performance computing environments fed on proprietary data feeds from the exchanges that cost millions of dollars a month and are vastly superior to the data that we have. They're always ahead. Not by a lot, but it only takes, microseconds to know that you are where the prices are going and to be ahead of them. So what do you do? Well, we tend not to like those because if something is 10% volatile, it could go down 10%. But what is the reason why we would be doing this in the first place? What becomes your safety net? The safety net isn't your stop and the opportunity isn't your limit, it's the data. If the data tell you there is excess demand and insufficient supply, whatever it does, the probability is in 1 to 5 days, you're going to make your return. So, I could say we don't give advice. We just furnish data, but the data are good. The data are very good at doing this stuff. So if you trust the data, let the data be your protection. And so you could go, wow, I'm down 7% on position. Be patient. Look at the market. As I wrote this morning, I got up. The Dow was, I get a cup of coffee before I work out, I do stuff, and I look at the Dow's up 189 points, and then I went and got the coffee. I come back and it's down 130 points. Right? What in the world? Right? How does that happen? Well, it tells you about the nature of the market today. It's very high speed, very mathematical. It is being driven by derivatives trades, and you can't trust what your eyes tell you. You have to look at the data. It's the only advantage we have. We cannot outcompete those people. They're vastly superior. So that my advice is, and I can't give advice, it is from my experience that you trust the data more than those. And maybe you could even go so far as to say, if you're scared, just take market on close and maybe you'll make your money, maybe you won't, but you're going to get the best price probably on average of the day. Why those? Look, they're not the only thing. I just know what clusters into the close. That's my view. So you can comment on it or we'll answer a question. Okay. One last thing, and we'll talk about what's ahead. So Brian and I may have slightly different opinions. I don't love this. When these are separations, Brian talked through the reasons for it. There's no question to me that the reason for that is this. It doesn't always happen that way, but because supply collapsed, relatively speaking, the patterns are almost identical up and down, that if you hit a peak on rising patterns of supply and then supply declines, what will price do? Well, it may not do what it normally does. And indeed, it rose. So beware of that. Now, I think this is the risk. This is the underlying price of all the stocks comprising the S&P 500 versus the volatility of all those stocks. And this is high and low prices. And I always look for these separations. I mean, we have another thing that we look at, but when the spread between the high and low prices, when the volatility increases, it tends to mark tops, not bottoms. And I look at this data, it's interesting that we are lower on average here than we were here in 2024. It does not reflect what you see in the broad measures, and because it is all AI, all chips and equipment and so on. There's a very concentrated part of the market that is responsible. 139 stocks are, call it almost $67 trillion of market cap. Okay, so that to me isn't great, but it doesn't mean it's going to fall apart. What it means is, can 20 stocks cause the market to continue to run, or will this manifest? I don't know. Brian and I have a running debate. I think this thing's going to crack, but I've thought it before and I've been wrong. What did John Maynard Keynes say? That being right and early is the same as being wrong. So I've been wrong about that, and we'll see how it goes. As to what's ahead, Brian, I'll let you weigh in and I'll wrap up.
Sure, sounds good. And while I'm doing that, Tim, maybe if you can take a look at David has a question there, so perhaps you can take a look at that when we get to that section.
Okay, and we'll wrap up pretty fast here, folks. We won't keep you long. I have to run. Actually, I've got a heavy afternoon schedule, so we will in 2 minutes we'll be wrapping up.
Yep, yep,
David,
yep.
good to see you. Thank you. Thank you for all
Um,
that you've done. Appreciate the communication. Is there a convenient numerical represent as you're doing that? I'll answer this representation of
okay.
divergence. So we use standard deviations. I mean, that's all we're doing. We're just calculating standard deviation between them. I mean, you can dump it and do it, right? The demand supply standard deviation. That's what we're looking at. If you run a model portfolio and you create a dynamic portfolio and you pick the divergence between demand and supply, it's standard deviation. It's just, you know, it's the population set standard deviation. Pretty basic calculation. Okay.
Yeah, just a couple points for me as we look ahead. I'll start with what I call the top 15, and this is literally what that sounds like. It's the top 15 by market cap. If we look at that right now, these guys are starting to bottom. And it's actually starting to bottom right around 6. It's moved up to 6.1. There's actually divergence in that set of portfolios. So top 15 is moving higher. I showed you earlier the outliers in the market. What happens after outliers? The market tends to go higher, even though sometimes it doesn't make sense. That's what it has done historically. Could there be exceptions to the rule? Absolutely, but I'm just looking at what has happened over the last 5 to 6 years. A couple other things to keep in mind. Watch big tech as we look ahead. Right now, it's actually fading a little bit. It's down to 5.8, not terrible. Uh, the components underneath that, Magnificent Seven, are at 6.3. So we still have some decent strength there. If it fades below neutral, to me, all bets are off. But right now, I think we continue to move higher.
And I mean, it's difficult to come to. I mean, I look at the dashboard and I don't love it. You know, if you isolate for um, big tech, I mean, really, it's difficult to find what looks great to
Mhm.
me. As Brian pointed out, you take the top, and the market is perched on 20 stocks. It is. It's the S&P 20 or the S&P MU, the S&P SanDisk, whatever. You know, so but if I look at the whole data set, I don't like it. But you know, I can't disagree statistically with what Brian is saying. So I guess we'll find out. I mean, you know, keep in mind, market is closed Monday, and month-end options expire on Friday. It looks like probably demand bottoms at about 4 or 5. It really does depend on what happens to finish out the week. Doesn't show that it's going to fall apart. Those spreads in the data that are underlying the benchmarks have historically shown that, but it hasn't happened. So, you know, we'll find out. I remain wary. I think that the market is way too narrowly concentrated, but that can go on for months, even years. I just don't know. You know, we'll find out. And with that, we will see you next week. Thank you for being here. Appreciate it.
See you guys.